All right, guys. Hi, this is Anthony Williams, and this is another episode in our asset protection series. I'm excited to introduce Mike Mullen with SCI Trust Company. I'll let him share a little bit more about who he is, what he does, and so forth. But the general theme, as you guys know, of this series is how do we protect our wealth from the various obstacles and hiccups that are so common out there. And there are planning things that we can do to address a lot of them, maybe not all of them, but a lot of them. And one of the things that always comes up is people are familiar with, hey, I'm supposed to fund my 401k and that's going to lower my tax liability. And, I've got the interest deductibility on my house and that's going to lower my income taxes as well. But I think one of the forgotten subject matters is actually taxes and the drain of taxes on our investments that aren't in retirement accounts. And Mike really has a wheelhouse in this. And so he and I are just going to have a conversation today. Again, appreciate you being with me here today. And of course, we'd prefer to do this face-to-face, but the brave new world of COVID requires us to do it over Zoom, at least for a little while longer, I suppose, with the 8 p.m. curfew in Arizona and the National Guard rolling out. So at any rate, Mike, if you wouldn't mind, just kind of share a little bit about you, your background, and then we'll just kind of have a dialogue.
Yeah, Anthony, thanks. I appreciate the opportunity to speak today and cover some taxes. So I work for SCI Investments. We're a global provider of investment solutions for financial advisors, institutions, and banks. My specialty is with independent financial advisors. SCI is a company we work with about 7,000 advisors throughout the country. Me personally, I cover about 10 states. And my goal and my job is to really help advisors provide the best solutions possible for their clients, whether it's tax managed investments, income investments, income solutions, really everything under the sun. So I work closely with Anthony and his partner, Mark, to provide the best solutions for you through various different implementation options and various different tools.
That's probably a good jumping off point. I guess just kind of give us a 30,000-foot overview of what are some of the different types of investments, different investment accounts, and how the whole tax thing plays out in there.
It's a great question. I mean, a lot of people are familiar with, a 401k or an IRA or like a brokerage account, but people don't really understand what category they fit into in terms of taxation and how they really work in the entire financial plan. So when I look at things, I really break it into two categories in terms of types of accounts. You have your qualified accounts, which are typically 401ks, IRAs, SEP IRAs, 401ks, 403bs. When we see accounts, we really break them out into two different types. You have your qualified accounts, and then you have your non-qualified accounts. Within the qualified accounts, there's really two categories. There's a pre-tax category. So this is money within the account that has not been taxed yet. It's going to grow tax deferred until you take a distribution out. And then there's post-tax money. So a Roth IRA, for example, or a Roth 401k. So this is money that you already pay taxes on. And it's allowed to grow tax-free. And then at the end of the period, when you go to distribute it out, you don't have to pay taxes on it.
When you move outside of the retirement space and you kind of go back, into the purely qualified environment, you kind of go more of the non-qualified environment. How do taxes, like what's the impact or what's the potential impact of taxes, and how does that diminish returns for those accounts that are not protected in those little tax-deferred bubbles?
Yeah, I mean, taxes play a huge part in non-qualified assets, and we've done studies where we've seen over like a 30, 40, 50-year period, if an account is not managed properly for taxes, the client can lose up to 60% of the returns just because of all the different taxation and whether it's on capital gains, dividends. There's a lot of different things that play into it, and we feel that it's not what you make, it's what you keep. So it's very important to maximize the after-tax return, not just the pre-tax return.
Yeah, the after-tax return is a huge thing that at least we find in our practice when visiting with other folks is often overlooked. And in fact, often is met with a fair amount of surprise when you talk about it. They're like, oh, wait, taxes? On what? So I appreciate you bringing that up. I guess when you think about the non-qualified accounts, are there certain types of investments? And obviously we can't get into recommendations and specifics in a format like this, but are there specific investments or investment vehicles that are, I guess, better suited from a tax standpoint?
Yeah, of course. So I would say the most tax efficient investment out there, if you look at just fixed income, is municipal bonds. So we're big believers in non-qualified accounts. A client should use municipal bonds if they're in one of the higher tax brackets, just because the income from them are tax-free, which is great. And then also, you can also invest in index funds. Index funds are very efficient from a tax standpoint because they're passive, therefore there's no active management. So there's no turnover, and turnover means a manager buying and selling stocks. So in a non-qualified account, if a manager is buying and selling a lot of different stocks, it's going to create short-term and long-term gains. And this can really eat away at the performance in the client's account over both the short-term and long-term. And then also, even if you look at mutual funds as a whole, they're probably the least tax-efficient investment out there. But they're also tax-managed mutual funds, which try to eliminate some of that high turnover I mentioned before and try to minimize capital gain distributions that are typically paid out at the end of the year and are taxed at the client's tax rate.
Yeah, no, that's great feedback. It actually kind of makes me think about when you see like some of the folks that have been do-it-yourselfers. They kind of have the brokerage account, they're doing the investing, and you run into these folks and they're like, yeah, when's the last time you repositioned your portfolio? And they'll say, oh, no, I don't want to reposition my portfolio because then I might have to pay taxes. And of course, that, kind of ties into this discussion. So I guess when we move forward from that perspective, Mike, and you think about tax management and how important that is, I mean, do you have any sense of how much wealth could potentially be lost by virtue of taxes? And I've kind of used an illustration. A lot of advisors use buckets of money to describe. You've got your short-term bucket, your medium-term bucket, and then of course your long-term buckets. And I'll just draw like a little divot in the bottom of the medium-term bucket and then kind of make it though, water's leaking out of it from the perspective of that's the tax drain on that. And so I guess two questions come to mind is one, do you have a sense of how much wealth, I don't know if that's too broad of a question, is potentially lost or any averages. But then secondly, perhaps more importantly is, what can money managers do? What can advisors do to offset that loss and that drain to wealth?
Yeah, that's a great question. So, I mean, at my firm, SEI, we've done a lot of study on tax management. So one study we did do is, so we went back and looked at if you took $100,000 and you invested it at the beginning of 1979 until now. So we looked at what's the pre-tax return and then what's the post-tax return. So from 1979, and if you invested $100,000, the pre-tax return is about $4 million as of the end of last year, which is a huge number, which everyone's extremely happy with. But when you factor in taxes, that number goes all the way down to about $1.6 million. So the client over that time period lost about $2.4 million in taxes alone, which is a huge amount of money and really lowers their wealth. And I don't think anybody would really want to lose that money to taxes. I mean, everyone's patriotic, everyone loves the government, but that's a big number to pay in taxes. And there's a lot of different things that we can do to really lower that number. So the big thing is when you think of tax management, everyone always says, oh, well, I do tax loss harvesting in my client's account. So what that is that's when you go in and let's say you have 100 securities and 20 or 30 of them may be at a loss. That's going in and selling at a loss to realize that loss to potentially offset gains. Most people typically do that in November, December at the end of the year. But at SEI, we actually do that throughout the year. So we'll go in and anytime there's a dip in the market, so this year is a perfect example with all the volatility in March, we were actually able to go in and harvest a lot of losses for clients to offset potential gains down the road. And really how that works is I'll kind of give you a real life example of something we would do. So for example, if you own Coca-Cola in your client's account and Coca-Cola is down 20%, we would go in, we'd sell out, realize that loss, but then we would go into a similar company like Pepsi, which is essentially the same business. They sell the same type of products. And it's probably going to have the same type of return in any market environment or any market conditions. So we turn around and buy Pepsi because you can't just go in and sell Coke, realize the loss, and buy back in because you would violate the wash sale rule. So that's why we buy Pepsi. We hold it for 31 days. We either go back into Coke or we hold Pepsi, depending on what happened with that specific position. And we can do that with any stock. We can do that with any bond, really. So we have a lot of flexibility in terms of the different things we can do. And then also, like I said earlier, we will invest clients in municipal bonds in non-qualified accounts just because the income's tax-free. And then ETFs is something else we do. Index funds is very efficient. And then we also have tax-managed mutual funds as well. So we have a lot of different methods, and we found on average through everything we do, we had about 1.2% return per year just in, we call it after-tax alpha. And that's really just limiting the amount of money you have to pay in taxes each year. So we're really proud of that, and we think it adds tremendous value to your clients.
Yeah, I mean, 1.2% is great. And so the moral of the story, if I'm hearing you, Mike, is there are strategies to mitigate the implication of tax. We can't eliminate it completely, but we can certainly reduce it. It adds about 1.2% of after-tax alpha when everything shakes out. And then I think where I'd like to kind of close with this, because that number was super powerful. Would you just say one more time, the 100,000 grows to 4+ million, and then what the tax is? And I think we may wrap it up with that. Yeah,
I mean, that's a big number. So in 1979, if you invested $100,000 until last year, you'd have $4 million if taxes didn't play into the picture at all. But when you factor in taxes, we found you lost about 60%, or about $2.4 million. And after that, all the taxes paid and everything, you're only going to have about $1.6 million left. So $2.4 million in taxes is a huge number. But there's ways to combat that. There's ways to minimize that, as long as you're investing the right way and you work with an advisor that knows what they're doing.
I mean, I don't know that there's a more powerful representation of that. It fits perfectly in this whole asset protection series of going from 4 to 1.6. I mean, that's just a remarkable number. But the key is there are strategies. And Mike, again, I appreciate you joining me in this series. And anything else that you wanted to add before we wrap up today?
Not necessarily. I think that's really about it. I mean, I think we covered a lot of good stuff. And I always recommend to work with an advisor, just because the value that they add is well beyond what you can even imagine. And, you know, taxes and some of the other things Anthony does for you and your family, I think it's very important. And, you know, an advisor is a critical role in your financial health moving forward.
Awesome. Well, hey, Mike, thanks again. Greatly appreciate the time, the insights. That's just an incredible number. We're looking forward to a 2020 that hopefully finishes better than the first 5 months of the year.
I think it get much worse.
It's unbelievable. But again, thank you very much for your time. Greatly appreciated. And we'll see you around the road.
All right. Thanks. Take care. Appreciate the opportunity.
Buddy, cheers.